Welcome to our session on cybercrime and cyber insurance. By way of quick introductions, I'm Erin Canale, Director of Cyber Risk Strategy here at Guidewire Cyence Risk Analytics, and I'll be moderating our session today. I've spent my career at the crossroads of technology and law in various roles, most recently transitioning from the U.S. Department of Homeland Security, Cybersecurity Division, where I led programs in cyber risk economics, cybersecurity data infrastructure, and privacy. I'm really privileged to be joined by a super panel of speakers. I'll start our discussion with some context on the topic, namely, with the proliferation of remote work, connected mobile devices, migration to cloud infrastructure and automation, the cybercrime threat landscape and attack surfaces have both accelerated and escalated. The growing attack surface, more specifically, is driven by things like more users. We've had a billion-fold increase in just in the last 5 years. We've got more data. Data went from about 9 zettabytes in 2015 up to 44 zettabytes in 2020. More network traffic. So IP traffic doubled, or more than doubled, I should say, in the last 5 years. As well, more network utilization. So think IP connected devices. We've seen a 50% growth in that regard over the past 5 years. And also more mobile connections, right? That again has doubled in the last 5 years from roughly 3 billion devices to 6 billion devices in 2020. So without further ado, Catherine and John, what trends are you seeing across the cyber insurance industry with regards to cybercrime?
So the trends that we're seeing across the insurance industry, you've noted a couple of them. So what we see is, because it's a short tail line of business, we are able to react pretty quickly to what the loss events are in the line of business. And you mentioned ransomware, business email compromise, or these social engineering fraud claims. And we do start to see carriers, implementing changes on how they provide coverage and pricing and how they look at the line in a whole. And the same thing with the SolarWinds hack, right? The SolarWinds hack in and of itself may or may not be a large insured event, but it most certainly has highlighted the aggregation potential of what of these supply chain hacks could look like. And what it does is that the market responds through coverage, and it responds through limiting capacity. So there are a lot of reactions to how the market is progressing, and we only have so many years of data to count on, so we don't know what the cycle is sort of in the cyber market yet. And so for that reason, we are much more reactive than even some other lines of business.
Great, John?
I completely agree with everything Catherine said. I won't touch too much on the trends we're seeing on the coverage side, pulling back of some lines, in some cases cutting entirely out of certain segments. But one trend that we're seeing, and one thing we're doing here at Optio is trying to look for any sort of loss prevention tool that we can work with and that will help our insureds or prospects effectively avoid or mitigate these risks. That's something they've been doing in the past quite a bit, but the change now and the trend I'm seeing is, and this is probably the wrong term to use, but I'm just going to use it anyway, just to get it across the audience, is that these tools will be more invasive than ones in the past, and they won't be things that are recommended. These trends are, I think, pushing toward mandatory utilization of certain prevention tools. And if you don't utilize these tools, you may be deemed by some carriers to be uninsurable, or you'll have to pay a much higher premium than you would in the past. I'm absolutely seeing that enforcement coming into play, and that's not something that is outside of the norm in the insurance industry. Not to use the same old adage that everyone uses with seatbelts in cars and how they're mandatory, but let's think about something like construction. There are mandatory requirements for safety in order for construction companies to operate on site. Those mandatory requirements are imposed by insurance companies. And if you don't do them, you won't get a claim covered. Cyber, I think, is moving in that direction. It will take a while. This isn't something that's going to happen overnight, but hopefully this trend continues. And maybe over the course of the next few years, we will see some mandatory requirements put into place due to the losses that we've been suffering through crime and ransomware over the past 18 to 24 months.
Great, thank you. And so, sticking on that subject, then it's the topic of cyber risk management and cybersecurity. So, how important is that to reducing insurance exposures? Are insurers, are carriers becoming more active in cyber risk management with companies? What challenges do you face in trying to be more active in that regard? And John, I'm laughing inside as you made that comment about, we'll get there, but it'll take time. I think it's been taking time for a long time at this stage in the juncture. So maybe if you want to comment on, what might facilitate that push towards more active engagement with insureds, feel free to do so. Catherine?
John, why don't you go first since
Okay.
Yeah,
you've
sure. And
got.
I'm sorry, I feel like I might have jumped the gun on that one and answered the
No, no,
question
no, it's
ahead.
all
I'm not
good.
prescient. I wasn't cheating or anything like that. I just jumped ahead to that point. But the importance of helping to reduce, and I use the word help and I don't use it lightly, is that this is not something that the insurance industry is imposing upon their insureds because of being, punitive measures. It is, especially in the small and medium market space. Let's just take the large companies aside that have their own risk management, their own CISO, their own risk managers. I'm talking about a bulk of the companies that really do get hurt due to a cyber event. The imposition of these programs onto these smaller and mid-market companies help, and they help because when they're not in place, we as the carriers, we as the risk takers, we're not just paying the loss, we're seeing these companies get damaged. We're seeing them be out for weeks at a time. We're seeing them have to spend most of their day restoring data, restoring their reputation. And if they had, I'm not doing a slap on the wrist here, but if these companies had these procedures in place, or even some of them prior to an incident occurring, it's not saying the incident wouldn't occur, but they'd probably get themselves up and running more quickly. And the recognition of that has been a long time running. You said, Aaron, it's, these things should have happened before. Absolutely. But the cyber insurance or any insurance, let's not forget, it is not bought, it's sold. And the selling proposition prior to this was more of a doom and gloom. Now it needs to be around, we're here to, this is a helpful thing. We've learned from prior experience that these measures, when put in place, will help you get back up and running again. That message has to go from the carrier to sometimes a wholesale broker, then maybe to a retail agent that doesn't quite completely comprehend the risk, to maybe an individual business owner who's just doesn't really want to buy insurance. Getting that message through is always going to be difficult. That's the challenge we have in an industry, but we have to meet that challenge.
There's a lot of information in what John just said, but I would also say that, historically, the carriers have they've offered these risk management services along with the products, and they've had to push them. They've had to sort of try to get the buy-in from the client to take up what they're offering and to become secure. And I think with the way the market is looking now, and to John's point, it's a little bit more now in the carrier's favor to now require some of these cybersecurity measures be in place before they even underwrite these clients, because history has shown that in the underwriting process, we can no longer be sort of lax about our client cybersecurity measures. So to that end, I think that not only do insurance companies probably have to push less, I think there's a little bit more of a demand now. And I think that demand comes from clients starting to understand what their exposures are. Like, they're starting to recognize that they have a need for this risk management, and it becomes something that they're more open to receiving. And, and to John's point, maybe down the road, they may not even have a choice at some point.
Yeah. Great. Let's pivot a little bit now to the topic of the insurance industry business model and its evolution. So, from your perspectives, what are the main ways you see the cyber insurance industry business model evolving? What are the drivers? So I'll throw out an example that you can touch upon if you'd like. Is this evolution towards digitizing the cyber insurance life cycle advancing noticeably, and why or why not? And I mean from the standpoint of prospect questionnaires to underwriting forms to selecting risks to adjusting claims and the risk control process itself. So in general, business model evolution, where's it going? What's driving it? John?
At a high level, I think yes, from the intake to the claims handling, the insurance industry, probably a couple of years ago, I think really began to grasp the importance of machine learning and AI in these processes. And it's not just about some almost sci-fi high-tech sort of approach to this. And just let's not forget we're talking about the insurance industry here, that is a notoriously slow industry to adopt just about anything. Case in point, not to knock Lloyd's, but there was a point up until recently where they still were trucking 3 tons of paper out every day from signed slips. So you're about as far away from digitization when you're seeing that sort of thing occurring. The adoption is being led by some of the major carriers nationwide. It's clearly one of those ones that's right up front. The smaller, more nimble companies are bringing some of these advances in, and then partnering with companies again like Guidewire are helping the industry move in a direction that if they didn't move in, it would be effectively, I think, put not so much out of existence, but definitely put in grave danger by some of the more nimble companies like the Amazons and the Googles of the world, who have figured out the I'm having trouble with that word, how to make things digital, let's just leave it with that, a long time ago, and can move very quickly. So it was almost, I'd say, the industry saw that their lack of movement was such a weakness and a threat that they had to make these moves. It's been slow, but it's getting much faster. From what I've seen, probably over the past 18 months, you've really seen a market change in the way carriers and insurers are looking at these technologies. Again, from everything from simply digitizing forms to using AI and machine learning and claims handling to identify the severity of an event, to identify, in better informed pricing for predictive models. All of these things were 5 years ago terms that were thrown out, I believe, by the executive suite to say, I checked off and said big data today during a speech. I firmly believe that. Now, that's not the case anymore. When you have an executive talking about board level decisions about AI and machine learning, they are making those decisions and they are deploying these technologies to become more efficient.
Catherine, thoughts on insurance industry business model evolution?
Sure. So, coming at it from a slightly different perspective, I do agree that we are evolving towards digitizing. Got it. Sort of the cyber insurance product and the underwriting, but I would say that it is advancing, but I would say that it also has some of its challenges, right? Right in times of profitability with soft market conditions, the amount of information the underwriters can ask for diminishes, and the number of market participants or carriers willing to overlook some of the gaps of information increases. But now that we're in a situation where we have losses coming in, what we're seeing is more of a reduced capacity and heightened scrutiny, which makes it easier for carriers to get more underwriting information. So why do I bring that up? Yes, there are segments of the market and certainly industry sectors that are easier to digitize and that there is a strong need. But there are also segments where the results and losses change rapidly, and everything only works if the technology also adapts that quickly. And here, I still think that the underwriters still have an advantage. They can react a little bit more quickly to some of the changes. But I don't believe that is across the board. You had a very big question in there too about, it was a loaded question. So I'll just address one other piece too is, how can carriers sort of achieve improved results, and how can they evolve, and what is the best way to do it? I certainly think that carriers cannot develop that. Not many carriers don't have the advantage of developing that capability internally, but definitely partnerships with other vendors can help give carriers what they need in order to keep up, digitize, react quickly. It's an easier way to be nimble and to act quickly to changes is probably through some of these partnerships that carriers can create and develop.
Great. John, do you agree? So in sort of getting carriers up to speed from an evolutionary perspective, there's, kind of three main models. There's buy, build, or partnerships. Do you also see partnerships as one of the main ways forward? And in like some examples of some of the main service providers that are stepping in to fill that role?
Absolutely. That is, we go through this with, now we're seeing a lot of this actually with our broker partners, in that they are in the decision making about buy, build. What should we do? Should we invest? Do we want to get on the tech treadmill? Do we know what that even means from an expense standpoint? Or is it better for us to simply rent this with the right partners? Do we find the right partner? And I think that's been, maybe with internal systems, that's been something that's been going on for quite a while now, as far as tools and technologies to improve underwriting performance. I'd say it's probably a combination of them. You build some, you buy some, you partner with others, sort of a triangulation. You're not going to be good at everything, but you do need to own a piece of it. I think when you get to a point where you are not building anything at all, unless you're in a highly specialized niche area of insurance, I think it would be difficult to survive without having some kind of skin in the game from a tech build standpoint. So, a case in point, I take my company, for example. We own a bit of our IT, but we absolutely partner with a number of others, and we are constantly discussing internally how much more do we build, and then when do we partner, and when do we buy. It is a constant game that's going to be going on for quite a while. But again, I don't believe it's, I'm going to build everything myself and not rely on anyone else, nor the opposite of I'm simply going to underwrite and rent the rest. I think there's going to be something in between, and that will be companies' value propositions when they figure out what that triangulation looks like. And that value prop is right in the middle of those 3 points.
We're coming up on the end, unfortunately. I think we could talk forever on all these topics. Bookend question to wrap things up for John and Catherine here. Let's talk about industry challenges and opportunities. And I'll prime the pump here. Understanding coverages and exposures, right? Those are key, both enablers slash obstacles to expanding this market. Do you think there's been much improvement across the industry in this regard, or is it carrier specific? And if that's not a major challenge or opportunity, then feel free to state otherwise. But sort of closing thoughts on challenges and opportunities for the industry.
I'll get it started then. I think that the quick pivot to the work from home has definitely highlighted the dependency companies had on their systems. So I think there was some sort of an internal education. The sales of the product historically is driven by sort of these large data headline losses that happen to very large companies. And I think with this new onslaught of ransomware and business email compromise losses, they don't impact the media the same way, or didn't impact the media the same way. But I do think that slowly but surely this news of these losses is filtering into sort of the small and middle market segment that remained unaware of what their exposures were and what the coverages were providing. And I think this does definitely, these obstacles are slowly being removed. I do think we're seeing a lot more new to market and a lot more people looking to buy more coverage. There's a lot more interest in the product because of it.
Great. And then John, bring us home here. Thoughts on challenges and opportunities.
So challenges outside of the scope of underwriting itself from a performance standpoint, I'd say one of the big challenges will continue to be the efficient collection of data and then what to do with it. And that is definitely on the carrier side. There's a lot of data that carriers have, but they're not necessarily turning that into actionable information. And that's difficult. And that is going to be, I think, a challenge going forward for quite a while. But it needs to be taken care of. As far as exposures themselves go, cyber itself is a dynamic exposure that continues to change. So the insured, what was an exposure for an insurer today is not necessarily an exposure tomorrow. The risks that in the events that happened 3 years ago, Catherine and I really don't even talk about anymore, because that's not really an exposure. And in a year from now, we might be talking about something different. So keeping up with that is always going to be, I guess, a challenge to keep up with those exposures and try to address them more nimbly than we have in the past as an industry.
You know,
Great.
I would add to that, while the types of losses have changed and we've seen an evolution in the ways of the losses, the one constant that I think is important to recognize in this line of business is the aggregation potential has been certainly a limiting factor. I think that without sort of a backdrop or a catch-all, or, you know, insurance companies, without the certainty of understanding their aggregation potential, it definitely does put a damper on the growth in this line of business.
Great. Thanks very much. Appreciate your comments here. We're going to tap this off here with some comments by Cody Stumpo on the Cyence product itself. Cody, if you just want to give a few remarks on, you know, a couple areas, take your pick. What has Cyence done with regard to responding to this challenge from COVID work from home? Is one option. Ransomware, again, everyone's hearing about it, kind of running around with their hair on fire. It's a prominent event. How is Cyence addressing that? And then also, you know, how does Cyence differentiate itself in the risk tech market that it participates in?
Yeah, thanks, Aaron. I'd love to, and maybe bring in some of what John and Catherine were just talking about as well. I think, you know, with the rise of remote work, the Windows Remote Desktop Protocol, RDP, became much more heavily used. You know, this is, it allows you to drive a Windows machine on your company's network from your computer at home, just like you were sitting in front of it plugged in. And this is a relatively secure protocol when set up properly. But keep in mind, the shift to remote work happened very quickly and was a scramble for a lot of IT departments. So if you have the standard RDP port exposed to the public internet, cyber criminals can take advantage of that. So maybe 95% of the companies that Cyence scans did not have this vulnerability, but, you know, 5% do. And so this actually became one of the leading entryways to the hot cybercrime of 2020 as targeted ransomware. Now, one thing Cyence does uniquely is both collect the cyber risk exposure signals and model the impact of those signals in a validated, quantitative way. Some competitors do one and outsource or partner for the other, but we control our entire end-to-end pipeline. And this lets us react quickly to the constantly evolving cyber threat landscape in a way that materially helps our clients. Once we had the hypothesis that RDP vulnerabilities were leading to ransomware attacks, we were able to start collecting that data and verify it for ourselves. And we were able to quickly offer a white paper, Taming the Uncertainty of Ransomware Risks, that quantified how much more likely a company with exposed RDP was to suffer a ransomware attack, and actually do the same for our other exposure signals, so our clients could see what of the data we were already presenting in our product could be used to help them manage this emerging threat. And that's part of the reason we offer both exposure signal data and a model, because the exposure signal data will often prove predictive of new threats the model doesn't yet consider. Now, shortly after that paper went to our clients, we were able to productize the RDP exposure signal and start providing it at scale for companies of all sizes. Now, we've released our targeted ransomware model as part of Model 5, Preview 1, which includes RDP, among other exposure signals and firmographics, in a precise and provably predictive quantification of risk. Targeted ransomware is roughly on par now to data breach as a threat. And so in addition to simply adding targeted ransomware to our loss model, we actually expanded the definition of our signature risk rating from the chance of a data breach attack to the chance of a data breach or ransomware attack.
Great, thanks very much, Cody. And I want to thank our panelists. We covered a lot. I think we boiled the ocean of cyber insurance and cybercrime. We could have talked for hours on this, but hopefully it gave you a nice introduction to the issue and the solutions on the table. And to the audience, thanks very much for your time and your engagement with us today.